I'm joined today by Bruce Russell from Alpha FMC, incorporating Shoreline, to really sit down and talk about sort of whole of fund in the context of asset owners, what it means to them in terms of their investment process, what it means in terms of the data, and equally some of the challenges and obstacles they face in the industry today. So thanks for coming in, Bruce.
Thanks, Pete. Great to be here and looking forward to an interesting conversation. Well, whole of fund ultimately refers to optimizing risk-adjusted return. So the fund is trying to achieve an outcome for its member, and that member is about effectively investment performance at the product level or the option level. So what we mean by whole of fund is really looking at all of our investment exposures. Importantly, it covers all asset classes, so public, private, listed, unlisted, etc. And it also is at an exposure view. So you're really looking at what is my sort of risk exposure to the market. And it covers portfolio modeling, portfolio management, rebalancing, and exposure management.
It's important that it's current rather than working off sort of potentially sort of multiple day old information. Then it's really about sort of overlaying that additional sets of data, including sort of the risk information, ESG, or increasingly SDG information, and then really how that gets used to sort of inform and adjust the asset allocation, the rebalancing to manage the liquidity of the fund or the assets, and increasingly sort of looking at that from a risk factor perspective as well.
I think the most important thing with investment data for whole of portfolio view is you've got to have a consistent view of portfolio data across all asset types. And that means that you need to normalize the data. So you've got the data itself has very different shapes. So private asset data, public asset data looks different, has a different characteristic, but as much as possible, you really want to try and normalize that view. The other thing you want to be able to do is to customize the view to support different investment needs. The reality is with whole of fund, you've got a broad range of investment professionals that are all accessing that data set. They've all got very bespoke requirements. So you need to be able to customize how people look at that data. And so you need to be able to, for example, configure things like country of risk, currency of risk, all those sorts of things. And I think the challenges are, firstly, just breadth, right? How do you cover all of those investment types? And how do you normalize that data, given what I said around the data inherently having a different characteristic to it? The other thing that we're observing with our clients is latency, just the delay in getting access to that data, and really inconsistent quality, particularly over things like private assets. So what does that mean? You lose trust, right? So the investment team can no longer trust the data they're getting, so they go and just fend for themselves. And so that's probably the biggest issue we're seeing at the moment.
Yeah, I mean, we certainly see with our clients that it's playing a increasingly critical role, particularly as more investment functions are being internalized. It's extremely difficult to be able to make those sort of investment decisions with any level of confidence if you don't have trust in both the timeliness and accuracy of the information. Yeah, and when we sort of talk about some of the obstacles, I guess those are the two that consistently come up. When we talk about timeliness, we're particularly thinking about some of the information about the assets that are maybe being managed externally, where potentially it takes 2 or 3 days for the information to work its way through the legacy processes, but especially around the private assets where there may be sort of months between different sort of valuation points. Yeah, so those are sort of the clear obstacles that we sort of see that people are facing in the industry today.
Yeah, I mean, it's a really common theme amongst particularly the large pension funds, the large asset owners, is why is this important? So I guess for us, it boils down to a few points. The first one is by having a complete and accurate view of exposures, you get a better understanding of your portfolio. You understand the return and risk drivers of the portfolio. And that means you can have much more targeted optimization strategies rather than having sort of very broad brush SAA, DAA. You can have multidimensional and very targeted strategies to optimize your risk return. The other thing is by understanding a point in time view with as less latency or as minimal latency as possible, means you can have a very coordinated and timely response to material market events. And that's been so relevant over things like GFC, COVID, you name it. There's a bunch of different sort of, call them black swans. There seem to be a lot of black swans at the moment. And it's been quite fragmented and ad hoc as to how funds have been able to respond to that. But if we've got a really good understanding of a whole of fund, you can have a much more of a consistent, coordinated and timely response to those events. And finally, because you understand and you've got a complete view of your portfolio, you can actually reduce and have much better implementation. So you can actually reduce the amount of implementation that you need to do, but you can also have, I guess I'll use the word optimized again, but you can have a much more optimized implementation strategy. That means you're reducing transaction costs and you're really, I guess, maximizing the value you're getting from actually implementing your investment decisions.
It really comes down to, again, before, the confidence in the decision-making process, but particularly about having confidence in being able to move quickly, being able to respond to those significant market events as they occur, and not sort of 2 or 3 days later after the impact has already been felt by the fund in essence. Yeah, and particularly, I guess we sort of see increasingly it's about having very targeted investment strategies. So, whether that's in the form of completion portfolio, so again, sitting over the top of that pool of externally managed assets, looking to make those sort of fine-tuning adjustments where you've maybe ended up with unexpected pockets of concentration of risk within the fund, or even where we still look at more sophisticated ways or sophisticated strategies in essence to you lock in things like gain or to sort of mitigate against downside risk in particular parts of the portfolio. Again, bearing in mind, as we said before, that you're not necessarily directly in control of all of the assets that are in that portfolio.
Yeah, look, it's something that we think about a lot, and I think there's a huge opportunity at the headline is there's a huge opportunity for service providers to help their clients. I mean, they're the natural, I guess, steward or custodian, dare we say, of the data. So to be that sort of consolidator and aggregator of the whole of fund view, and helping sort of address those issues we talked about, better quality, reduced latency, consistency, both breadth and depth of data. I think the custodian, particularly custodians, are the natural parties to help their clients solve that problem. The second thing is, I think technology's hard, and clients don't like putting in and having to go down the path of large scale technology replatforming. That's not the business they're in. They're in the business of investing. So the more that the service providers can reduce that technology impost on their clients and can think about themselves as being as much a technology partner as a service provider, I actually think that in itself is also going to help clients, and the clients can get on and focus what they're good at, which is investing. I also think from a data perspective, service providers, and this is probably one that I still think needs to happen more, is they should be an extension of the client's data management capability. So an example I quite often come back to is data governance. It seems crazy to me that an asset owner will have their own data governance framework, and then the service provider will have theirs, and never the twain shall meet, right? You're better off having a single continuous data governance capability. So the more that the service providers can help build out, and I call it SME data services, and offer those into the client as an extension and a continuous workflow, for want of a better term, then I think that's actually going to help a lot, because clients are struggling to stand up their own internal data capability. Getting access to skilled resources is a huge, huge challenge. And so I think service providers have a real role to provide, dare I say it, almost consultancy style based data services back into their clients. I think the other part of your question, Pete, was how do they need to adapt their offer? This is going to sound weird. Don't think like a custodian. And that's not a criticism on a custodian. The way custodians need to think about delivering their services makes sense in terms of what's important as a custody, reliable, sort of infrastructure, trusted. I use the analogy of a bank vault. No one's going to break into that bank vault, but it's not it's counter to what it takes to be, I think, a successful partner from a data services perspective, which is agility, nimbleness, some level of risk aversion, because risk is a contextual thing. So, by the more you go down things like IBOR, the more you have less certainty on that data. There's as much art as science in terms of, so some of the features that are important to be a really successful custodian, you actually need to flip on the head and have a different approach, I believe, to provide data services.
I think the message we hear loud and clear from our clients in the conversations that we have is that it's no longer good enough to be an arm's length service provider. We can't simply operate in a vacuum in a black box and just deliver sort of information at arm's length to our clients. We have to sort of come into the fold and work much more closely with them as a strategic and trusted partner, and not just with the clients themselves, but also with their other trusted partners. Going back to what I said a few moments ago about TPA, that's a big part of how sort of TPA works, is working very closely with sort of trusted partners in making sure you're all focused on delivering the outcomes. I think for us as a service provider, when we partner with those clients, they're looking for us to help them in a number of key areas, and you sort of touched quite rightly on sort of the data governance, the data management side of things. Clearly we have vast amounts of information, more than any individual sort of asset management or asset owner would have of their own. So we have a lot more sort of depth and breadth of understanding of the types of information that are out there, and a lot more experience in sort of managing and sort of dealing with that data. But equally, and you touched on it, the people side of things, we have a lot of very skilled resources, and those are things that are very difficult for our clients to sort of manage and ramp up and scale themselves as their businesses grow, both in size but especially in complexity, and again as part of that sort of internalization journey. Sort of the word I would use in terms of talking about sort of the management of that quality, and moving from being having to be 100% to maybe sort of the risk, having a bit of risk aversion sort of in there, is the data has to be defensible. It doesn't always necessarily have to be perfect, because that's sort of an impossible dream, particularly in terms of some of these private assets, for example. But as long as when we're talking to our clients, and when our clients are talking to their boards and to their members, as long as they can defend the information, they can show how it was derived, where it was sourced from, explain why it was being used and how it was being used as part of the process, then that's sort of acceptable. That's a reasonable level of risk to take on. So I think defensibility of data is absolutely sort of key in these conversations. And you're absolutely right. I mean, that ability to dial up, dial down services is going to be critical, particularly as funds go through the sort of evolution. And as you said yourself, they're all on different journeys. There's a spectrum of capability that they're looking for at any given point in time. And we certainly sort of see, I guess, that as funds are going down a journey, they want to try and figure out the right way to dip a toe in the water and see if something is going to work for them, and don't necessarily want to sort of stand up the cost of whether it's a technology platform, the teams, the people, the human capital that's required to sort of do those things. So being able to work really closely with sort of the platform providers, service providers, to look at building out a model that provides flexibility in terms of the technology side, the servicing side, but without losing the visibility, without losing the transparency.
So we think it comes down to three fundamental points. The first one is we're not bound by physical investment structures. So the traditional model of options into sectors, into subsectors, into portfolios that are effectively a unit pricing structure, that is effectively unbundled, and we just have a pool of assets and we can group them any way we want. That's going to give us much more flexibility on our investment structures. Second point is we have a true IBOR. And what I mean by true IBOR is a view of the portfolio that's not bound by conventions associated with regulatory, accounting, or compliance requirements. And the IBOR is a true independent view, and it's got lineage back to the official records, such as the Accounting Book of Record. And I think the third point is we've really eliminated latency in the data, and we removed the sort of data quality distinction between internally and externally managed portfolios.
I might start at the far end of that timeline and be super optimistic in this. And Yeah, I think one of the things that I think is decidedly possible is, as there's more of a focus on the members themselves and on sort of member engagement, and as some of the funds have to compete more for member money at the end of the day. I think we'll see sort of a continuation of the trend towards sort of personalization of the products, but still trying to make that fit within the constraints, if you like, of trying to manage a collective pool of assets as well. So I think, sort of call it 10 years from now, we will hopefully see a situation where members will be able to interact almost real time, directly with their own sort of portfolio of assets from a pension perspective, whilst having that sort of still feed into that whole of fund view. And I think we'll sort of really see the investments teams having to be sort of much more responsive and nimble to those changes that are coming in from members. So I think we'll start to see like a real blurring of the lines between what people think of as being pension portfolios and what people think of as maybe some of wealth products, managed account type of solutions. I think we'll see a real convergence of those. 10 years would be sort of optimistic. It might take us a little bit longer than that, but shoot for the moon and see where you land, I guess. I think more realistically, we will see sort of an increase in the number of funds that are working off a real-time investments view of the fund, as opposed to working on a very constrained accounting led view of what the assets and the structure of those assets look like, and dealing with the inherent latencies and sort of challenges, if you like, of running an investment book based on a view that's designed for regulatory or sort of performance type of reporting, as opposed to managing sort of investments.
I really think it's interesting about how AI might feed into this. So one scenario I've thought about is, what about attaching a sentiment score to your assets that is based on a real-time incorporation of factors that are influencing that investment, and you use something like AI to convert unstructured data, so it could be news, it could be events, it could be anything, to convert that in real time to a sentiment score and apply that sentiment score to your... So it's just another factor. Like we talk about country of risk and currency of risk, so we could call it sentiment of risk or something like that. And you've got the power of AI and that's moving so quickly that you've just got this huge ability to convert unstructured information and harness that and transition it into a much more structured concept that's needed for the eyeball and apply that in real time. I think having a much more open architecture model of exchanging information between asset owners and asset managers is something that we're starting to see quite a lot of traction towards. So the current sort of more traditional model, for example, is the manager would give up their trades to the custodian. That would go into the accounting book of record. The accounting book of record would then get sent to the fund, who would then turn it into an IBOR, but it's effectively IBOR that's built from the ABOR. And so there's a lot of lag and latency in that. You're sort of standing behind the ABOR. So we're certain, and some of our clients are moving much more towards an IBOR that is much more contemporaneous compared to the ABOR.
Yeah, I mean, it is, and it's a big part of the conversations we've had with, particularly again, some of those larger funds where I guess they're more concerned that they potentially have, whilst they have a set of mandates out there, that within the boundaries of the mandates, they may end up with larger than expected pools of lazy cash sitting around, for example, or they may end up with sort of concentrations of risk drifting in a particular direction sort of through the day. So as you say, that sort of nearer to real-time type of view of the whole pool of assets, including the external ones, is certainly a big part of the conversations that we're having. You're right, there are sort of industry initiatives that are designed to sort of tackle those solutions in a sort of very standardized and an accessible way, because I guess accessibility is sort of key in these types of solutions. But those are very real challenges, and the challenges that we've actually solved with a number of clients in region. I'll sort of be honest and say that the reality is that they don't quite want real time at this point. That's a little bit sort of too scary because they feel like things will be moving too quickly and they won't necessarily have time to react, because when you think about the numbers of managers, transactions, assets that sit in some of these funds, it's
and be careful what you
huge.
wish for, right? Because you
Absolutely.
might do something where a manager's halfway through a rebalance, right?
Yeah.
So you've got to be careful.
So at this point in time, it's sort of I guess more about picking a few points sort of intraday where you refresh the information set, for example. So it might be that you do it sort of by region. So maybe as you get towards the end of the sort of the Asian trading day, you do a refresh of those, and that allows you just to reposition those exposures for those markets or whatever it might be at the close of that business day. So at the moment, it's more of a gated process than a streaming information process. But certainly I think the industry is moving in that direction. I mean, we've already done that for a number of funds in region. It gives them a lot of flexibility in the way that they run the assets, a lot of flexibility in the strategies that they employ, particularly in terms of managing the risk profile of the fund more on a real-time basis. And I think a lot of those conversations for us really started about some of the challenges at the beginning of the pandemic, when all hell broke loose in the markets, and there was a real crunch on liquidity in some of the funds. So not being able to understand what was happening and not being able to see where they would be potentially able to access those pools of liquidity in the time frame needed to satisfy people switching into the cash options, for example, caused a number of funds some real sort of internal challenges and concerns. And I guess for us, that was sort of really the genesis of a lot of the conversations about how do I go from, as you sort of say, that very lagged view that's sort of driven and built purely from the accounting data to something that allows them to be more nimble and agile intraday. Thank you very much for your time today, Bruce. As always, it's been a sort of fantastic and engaging conversation. It's always great to hear your insights from the conversations you're having in the industry. And I look forward to sitting down with you again in the future and continuing this conversation and this journey together.
Great. Thanks for having me.